Joining me now, Post 9, Wells Fargo's top bank analyst, Mike Mayo. Welcome back. It's good to see you. Why are these banks doing well of late?
Well, why do they do so poorly before? I mean, the banks are the most resilient they've been in decades. Their core earnings power is 20% higher versus 2019, even when the stocks went down the last several years.
Why are they getting rewarded, though, all of a sudden? Or at least we said the last 3 months, they're outperforming these blue chip names that we talk about seemingly 3,000 times a day.
Look, there's three issues for banks, the three R's, and that would be rates, recession, and regulation. And each one of those is less bad. So when it comes to interest rates, you can't unsee the December Fed pivot. When it comes to recession, it seems a little bit less likely than before, and regulation seems like it'll be dialed back a bit.
Okay, so you posed the question rhetorically almost at the top, suggesting, well, why were they down so much before, as if they didn't deserve to be? But then you said, given where interest rates were, that was a substantial headwind with worries about what the ramifications of all that are going to be to the economy. So maybe now we have a roadmap to lower rates, so these stocks are working. It seems pretty cut and dry.
I think to some degree, this is the third year in a row when the industry should have lower earnings. You're looking at earnings growth for the banks to be down 20% over 3 years through the end of this year. Mm-hmm. But after that, we see earnings up by 1/3 in 2025 and 2026. You'll see a hockey stick type projection of earnings starting more later this year, but I think the stock market's not going to wait.
Okay, so why do you have such differing views, let's just say, of JP Morgan versus Morgan Stanley? JP Morgan is part of the list of your names that you follow where you have overweight ratings and nice lofty price targets to go with. Morgan Stanley's equal weight. What's the difference between the way you view both of those stocks?
Well, both have performed exceptionally well, but Morgan Stanley simply is pricing in a lot more growth at a time of decelerating inflows into their wealth management business, outflows in their investment management business, and frankly, flat to slightly lower market share in their institutional securities business. On the other hand, JP Morgan is a clear market share gainer over the past 1, 3, and 5 years. So I'd say market share and stock valuation differentiates them. And don't leave off Citigroup, which is my number one.
Well, that's your number one pick.
My number one pick. JP Morgan's my number 2 pick, but that is a worst-in-class story that's becoming less bad. Morgan Stanley was a great story that's becoming less great.
Okay, that makes me want to ask you about the leadership of these particular institutions, but both the job that Jane Fraser has done in reinventing, I don't know if that's too strong of a word, but nonetheless, she's done a lot of work that's gotten applause from investors. That's fair to say. James Gorman leaving Morgan Stanley, and do you feel like Ted Pick this is a prove it moment for him? Is that in part any reason why you're a little iffy on that name?
Look, Ted Pick has been part of the team over the last decade that has really transformed Morgan Stanley into a higher return, more resilient firm. So I don't think he has something to prove in the short term. I think over the next 3 years, though, I mean, it's tough comps for Ted Pick compared to the last 3 or even 15 years.
But they're in the crown jewel business, aren't they? I mean, well, Gorman positioned them in wealth management, which was this great business to be in. He saw it before most, leveraged themselves big to that. Wasn't that a winner? And why wouldn't it still be?
Wealth management is a battleground. Scott, name me one bank that doesn't look to wealth management as a place to grow. And Morgan Stanley's inflows, they did go very high. They went to the double digits, and now they've been growing 3 to 4% inflows. Their pre-tax profit margin was 30%. Now we're looking at maybe 25%. So again, it's going from really good to great to just not quite as great.
So you watched the Diamond interview today on CNBC? Because it was an exclusive. It was a great time to catch up with him. Anytime you start talking to him about regulations, he sits up in his seat, his voice picks up a little bit. He was asked about the impact of regulations on lending, the massive growth in private credit, commercial real estate, what possible issues are down the road because of all of that. I want you to listen to what he said and your reaction on the other side.
Okay.
Jamie Dimon on bank regulations.
Banks are being pushed out of a whole bunch of different businesses, and I always say if that's what the regulators want, then do it. I'm completely fine with it. JP will do fine, but it should be done with the forethought, not accidentally. Like I said, there are some negatives, so I think if you have a major recession, you'll probably see some issues in private credit. Whether it's systemic, not, I don't really think so, but it might be in ways we don't understand today.
How do you view that?
I think you used a word that really got Jamie Dimon boiling, and that word is regulation. And look, when I look at J.P. Morgan and the regulatory proposals, I'm looking at a $60 billion difference in the amount of capital that they have to hold, and that, I estimate, equates to $2 of earnings per share, which equates to about 25 points in its stock price. So if these proposals don't go through, that's a 25-point difference in its stock price based on the earnings that they could generate off that $60 billion of extra capital. So he's in a battleground with regulators right now, along with some others, because he's fighting for the investors and fighting for that extra $2 of earnings per share, extra 25 points in its stock price.
Okay, so if they do go through, do you need to rethink your stock prices and your ratings?
Nope, I'm assuming it goes through right now. I have the much higher capital targets. If it gets dialed back or doesn't go through, then we have some dry powder for some higher earnings estimates, as does consensus.
Appreciate you coming to Post 9, Mr. Mayo. We'll talk to you soon.
Take care.
That's Mike Mayo, Wells Fargo Securities.